Alright, I'm still a little bit sick. Okay, so do excuse my voice for this whole entire video. But we have to talk about CPI. We gotta talk about PPI. We gotta talk about FOMC. And we gotta talk about bank earnings. Volatility wise, let's talk about this first. CPI is gonna be pretty highly volatile, okay? Because the thing is that we are not getting a number that we like, yeah, we're going down. Okay, even if we get a number that we like, it's not gonna be going up by that much because nothing is concrete as of yet. Thursday, we're going to get PPI. I would say medium volatility. A lot of people do look at the data set as it is, but I don't think that retail traders do look at it as much. I think a lot of hedge funds do just take in the economic data as it is. Early FOMC minute. I do want to talk about this a little bit. Okay, I want to touch upon this a little bit more. Okay, so from the previous FOMC, actual FOMC meeting that it is, we had the whole banking crisis as well. During the banking crisis, we still managed to raise interest rates by a 25 basis point. Okay, so of course that is going to be properly iterated in the minutes this time around, which is what we're going to be getting on Thursday. What we are expecting is for the minutes to be clean, where there's not going to be any hidden bombshells where you're going to be creating a huge volatility for the market. That's what we're going to be hoping for at the very least. Okay, if you're bullish in the market, that's what you're hoping for. Okay, but if you're bearish in the market, okay, what you're going to be hoping for is somewhere in the minutes they actually say that, oh, because due to the banking crisis recently, in order for us to not scare the people, we are going to be continuously increasing by 25 basis point increment. Because we were actually supposed to go for a 50 basis point increment, something along those lines, a little bit like a bombshell sort of thing. Okay, that's going to be really affecting the market if that was actually written on in the minutes itself. And then finally, we have to talk about your bank earnings. Okay, well, earnings in general, but bank earnings usually start off the whole entire earnings season. So we're going to be starting with JPM. Okay, I'm going to be coming back to inflation in a bit. Let me just finish up the whole entire banking earnings and how this actually affect the market just a little bit for you. Okay, so we all know that due to the recent implosion of all the banks, what this actually affects. Okay, it's not just gonna be affecting a little bit. We're not just affecting the regional banks and such. That's not that easy. Okay, with your four banks getting imploded, okay, what's going to be happening from here on out? The central bank is going to be putting more restrictions on your top 8 banks, your top 20 banks. Okay, all these banks, they are going to be telling you, okay, you know what, you guys are not supposed to be this risky. You guys need to at least have this much percentage before you guys can actually do this level of risky investment, and here on and so on and so forth. When that actually happens, it means that the banks in general, okay, their main source of revenue and income is actually coming from all this sort of investment, all these different financial vehicles that they actually provide for its clients, and they actually get a cut out of it. If they're not able to do such volatile investment or such high risk high return investment, it means that the return rate, or well, revenue and income, will definitely be cut down. Okay, so that means that's your revenue down as it is. We are most likely going to be seeing a very, very tiny bit for this earnings report, simply because I don't think that the banking crisis, quote unquote, actually let us see the whole entire picture just yet. I do believe that it will be more nuanced, or basically more reflected in your next earnings report, most likely to be the case. Okay, and also because of the whole huge implosion of the banking industry, a lot of people are starting to lose faith in the banks. People are starting to just chuck money into brokerages because you can get a higher FDIC insured on it. People are putting it into treasury bills because you are actually a lot more safer with treasury bills. At least you're going to be getting the money in a fixed amount of time. So for banks in general, for them to actually entice the customers to come back to them again, to deposit money to them again, what would they have to do? They would have to increase the deposit rate again. So for example, right now, the flat rate is at 0.05%, for example. They might have to entice you a little bit and just be like, you know what, just bank with us. Just bank with us and we'll give you like 0.2%, for example. Okay, or your fixed deposit, or your structured deposit, every single year, you know what, we're gonna give you 4.3%. That sort of thing. And all this additional percentage that they're actually giving to the client, these are all cost of acquisition. Okay, if you want to really call it, it's also part of marketing. Okay, so marketing is most likely going to be going up, cost of acquisition is going to be going up, and the profit is going to be going down. That's double whammy. You're getting destroyed. You're getting destroyed from the front and from the back. Okay, so banking as it is, that's going to be affected. Okay, so banking as a whole is most likely going to be having 2 quarters, possibly more. We're not very sure, but at least 2 quarters of so-called like uh, more strenuous earnings for us to actually see. So what does this actually affect? Because when banks are not allowed to be this risky when it comes down to investing and such, the people, the companies who actually borrow money from the banks, they are going to be affected as well, which is your tech sector, your discretionary sector, your industrial sector, your medical sector, all this so-called all this sector, people who are trying to innovate for newer technology, innovate for newer cancer improvement, I don't know, like freaking like height inducing, what I don't know. Okay, all this sort of like new innovation studies and such all require money. And all this so-called innovation usually comes with money that needs to be borrowed from the bank. And if the bank is not allowed to borrow to as many people as they were before, it means that there's definitely going to be a limited amount of people who are going to be getting the funding, and those people are not able to actually help to further the innovation of the country. You don't have to be the United States. It could be whichever country it is. Okay, as long as you're dealing with the bank on its own. But I'm just assuming, in this case, let's just talk about the U.S. Okay, that means U.S. is not going to be innovating due to this whole banking industry. Okay, and this is going to be affecting GDP in the long run, which is why this is a huge reason why people really think why this banking industry was a lot bigger than it was. People were really, really worried, and this is one of the huge reasons why. Okay, so this is going to be affecting tech. You're going to be affecting industrial, medical, pharmaceutical, discretionary staples to some level as well, and yeah, I do believe that that's going to be, and when that actually trickle downwards to the second company or even the third layer of companies, then that's when you kind of see that, oh, okay, maybe we might be in some form of a recession when that actually hits, because companies are not able to get enough money, enough funding from the banks. The customers are not really spending as much with those companies as well, and eventually they have to go bankrupt, and that might actually affect the whole entire chain in the whole entire system, that sort of thing. So yeah, pretty interesting for us to really be seeing this in real time. I'm not sure if we're going to be seeing a huge collapse somewhere in the system in the next coming 9 to 12 months. But I'm very, very interested to actually see how it goes and hopefully document it down via YouTube as well. Okay, now let's talk about inflation. Okay, so I'm pretty sure that we all already know about inflation. Inflation is going to be, well, right now we're expecting inflation to be not as bad, okay? A lot of people are still thinking that inflation is going to be sticky. I believe that inflation is going to be still sticky, okay? And if inflation were to come out to be like 0.5, 0.6, I'm not gonna lie, I feel that that's gonna be very, very bad for the entire economy, because that means that whatever inflation that we fought back in 2022, well, 2000 end of 2021 till the mid of 2022, whatever that we fought back then is coming back again. Okay, we want to see a continuation of 0.1s to 0.3s for us to really kind of just push this inflation monster downwards. When we are pushing this monster downwards, we thought that we're done, and then we just continue with it, and the monster just come from the back, that sort of thing. And that's kind of what's happening, because in 2022 we kind of really push it downwards, 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 and then we thought, oh, okay, we're in the clear. Okay, even Jerome Powell, in his sleep, most likely he thought that we're in the clear. He continued on, and then poof, came back up. Okay, so that's what we're kind of worried about, and I'm not sure if that's very, very valid as well, simply because Jerome Powell and myself as well, we thought that inflation was going to be transitory. Who knew that it's going to be so sticky to the point where, and right now, it's going to be one of the most important thing that we all talk about today, because if inflation is not going down, the US dollar, currency in general, all around the world is going to get destroyed bit by bit. And hyperinflation is going to be happening. If this inflation does not get clashed down, it means that it's gonna go out of like spiral out of control. And when that actually happened, then that means that dollars, currency in general, have lost all meaning, and we basically just have no use for currency at all. Yeah. So yeah, but anyway, that's all I have for the inflation part of things. But anyway, that's all I have for this video. I need to go and eat my medicine. So yeah, thank you guys so much for watching, and I'll see you guys in the next one.